right. Good afternoon, everyone. Thank you. So for those of you that don't know me, my name is Anissa Moljani, and I'll be the host for this afternoon on behalf of Brett and Jeff. And so Jeff is here, but will be joining us virtually, and he'll be actually joining us momentarily to let you know why he's joining us virtually. And the entire CRE team, I would like to welcome all of you to our second annual client update. So the agenda for this afternoon, we're going to have Brett is going to get us started with an update on the team, as well as tell a brief story on building wealth. This will be followed by Peter, who will talk about the financial life cycle, and we'll focus on investing, tax, and estate planning. And once Peter is done, Jeff will join us again, and will give us a market summary, portfolio update, and outlook. And we'll finish off the session with some time for some questions from all of you. So at this point, we'll bring Jeff in. Hi, Jeff.
Hi there. You see me?
Yes, we can.
Okay, good. Sorry, I'm in the room next door here. I just got as I pulled into the parking lot about an hour and a half ago, I got a message from our other portfolio manager, Victor Dawydiak, that he tested positive for COVID, and I've been feeling sick all day. So I ran around Burnaby for the last hour and a half trying to find COVID tests. Found an expired box, tried 3 of them, and one of them came out positive. So I thought that was a good enough reason not to get you guys all sick. So I'm here next door, all dressed up fancy, but I'm not going to infect the crowd in the room. So hopefully I'll get to see you guys all in person soon. And I guess I'll turn it over to Brett, and then I'll come back in later and talk about the markets.
Great. Thanks, Jeff. Yeah, there's your this one on. There's your surprise of the day. Sorry about that. That's as we were getting ready to go, Jeff called in. Like, uh-oh, I'm in a bit of trouble here. So you can look at him in the next door room. He's literally next door to us. But so I guess we'll go ahead with getting this evening underway, and hopefully this is my forward button. Great. So we're here today. I'm going to start with the team update and tell you a little story based on the book that's on the table, and then Peter can go ahead and do a little bit, talk about as our financial planner, give you some information and get you excited about the financial planning, and then Jeff will come back in. So the team is continuing to grow as always, and so the people who aren't here are Vic and Kathy. Vic obviously tested positive for COVID and let us know just recently, so he's not joining us. And I think everybody else you've probably bumped into. Everyone was here last year. But we've categorized it in the different groups now. So portfolio management team is Jeff and Victor and Jeff and Charlie. And then on the wealth management side, myself, Anissa, Peter, and Philip. And our client service team, Angel, Rosa, and Kathy. So these are the new faces of the team this year. So Victor comes to us as he's been with National Bank for 30 plus years, has the best top rated basket performance of any advisor at National Bank Financial, which is really great in terms of giving us more horsepower on the team that picks your stocks and picks your bonds. And he's joined our team and is handing over some of the client service work to us, but staying on as a portfolio manager to work with Jeff on that side of the team. And the other new face, which you will see here today, is Philip in the middle. Philip comes to us as a wealth associate, but I've known Philip for years. He worked with BlackRock and several other exchange-traded fund companies, and we were his clients essentially, and he was always teaching us what was new, the newest products coming to market. So it's great to have his wealth of experience and knowledge joining us as well. So with those as the changes, one more, Anissa. So Anissa has been with us now for 2 years, but she has actually moved up the ladder, so becoming a full-fledged wealth advisor at this point, which is great because, again, the title's changed, but she's been doing the job for probably 20 years, so it finally got the right title with the job. So thank you, Anissa. And then, of course, there's a couple other Derek's in the room, some of our trusted colleagues at National Bank, and then also we always do work very closely with other partners, with our strategic partners being the lawyers and the accountants around town. So it's, especially with the financial planning, it's pretty important for us to have that group of people that we can reach out to. So today I'd like to do a little talk about Morgan Housel. So Morgan Housel wrote the book, The Psychology of Money. There is one copy on the table. Someone can take it home. If anybody else wants a copy, just let me know and I can get you one. We were in Montreal this year at our conference, and Morgan Housel came and did a presentation to us, and I thought it was very interesting and timely for today. He told a story in his opening of two friends, and they went to a billionaire hedge fund's party on Shelter Island, and the one friend turned to the other and said to him, he said, "You know what? This," and his friend wrote Catch-22, is a pretty famous author himself. And he said, you know what? This hedge fund manager made as much in one day as you did writing that book, collecting all the royalties on it over its entire life. And the author turned to him and responded, and he said, "Yeah, but I'll have something that hedge fund manager will never have." And he said, "And that's enough." And I think that was really profound. I think that's coming out of COVID, running right into the teeth of hyperinflation and rising interest rates. I think it's important that people think about this and money in a different way. And this is what Morgan Housel did. He's able to help you think about things with he's not going to tell you stories about financial planning. He's definitely not going to tell you stories about investing, but it helps you change your mindset and think about money a different way, and that can help you build your wealth. So I wanted to sort of tell a story that Morgan told while he was there. And this is it's an interesting story. It goes back to 1968, and it's the London Times started a competition. And the competition was to race a sailboat around the world, first solo race around the world. And it wasn't really a competition because it had never been done before. So it was really just changing the idea of sailing. And it wasn't about the winner. This story is not about the winner of this race. There was 12 people who started. In fact, only one person out of the 12 even finished the race. But I think the story comes down to that there's two particular sailors in this race that it's worth kind of taking a second to think about them. So the first one was this fellow named Donald Crowhurst. So Donald Crowhurst was not a sailor. He was a bit of a failure, actually. He failed out of the army. He failed at being a pilot. He failed at business. And he decided he needed this race, and he needed to win this race in order to get back, just have one more, to get back into society and be a winner. So Donald, he built his own boat, and he's not a carpenter. You would say, is this guy a carpenter? He builds his own sailboat, but no, he built his own boat. He's just, he's trying really, really hard, and he did pretty well. He started his race, and he sailed down, and he got halfway down to the tip of Africa there, and his boat started to leak. And so he really had two choices. He could either turn around and sail home, and he would be a failure once again, or he could carry on to the rougher waters in the lower Atlantic and probably die. And so he chose a third option, just pure fraud. So Donald turned his boat around, went up to the calmer waters, kind of off Newfoundland there, started going in circles. He didn't go in circles for weeks. He went for months. He decided to keep sailing in circles, and he would call back and he would say, well, I'm sailing around Australia right now. I'm doing great. I'm off to Tahiti now. So he's radioing in fake positions, and he's just sailing in circles. And so this goes on for 6 months. And so now he's run out of supplies, and he's like, okay, I got to get home. And he realizes that he's in trouble. Not because he can't make it home, but he realizes he's so far ahead of everybody else in his mind that he's going to win this race by a landslide, and his fraud is going to be found out. They're going to look into this and say, well, how did this guy beat everybody else by that much? So all of his thoughts are recorded in a journal, and a fishing boat found his ship, and in the ship they find his last entry, and it says, it's finished, it's the Mercy. His boat's in good order, and he's not there. So you don't have to guess very hard to figure out that he's ended his life, jumped off the ship, and gone away with the fraud is over for him. So that's one story. And then the second guy in this race is Bernard Montessier. And so this fella is a sailor. He is exactly what you would expect. He looks like a sailor. He's an amazing man, spent his entire life on the water, and he is racing around the world. And if Donald had known it, Bernard was actually pretty close to behind to where he would have been. So he would have just edged out Bernard if he'd come in. So he shouldn't have jumped. He should have sailed home. But he didn't know this. So Bernard is actually done that. He sailed around Australia, and he's heading on his way back up. And he is having a really tough time with his mind because he really hates the fact that he's going to go back, win this race, and then be get dragged through the talk social circuit, go into society. He's just so upset. You can see what he's thinking in one of his journal entries is, I really feel sick at the thought of getting back to Europe, back to the snake pit. I'm really fed up with the false gods, always lying in wait, spider-like, eating our liver, sucking our marrow. I charge the modern world. That's the monster trampling the soul of men. So this is Bernard's mindset. So you can see what he thinks of society and the whole thing. So he ends up, doing the same thing. He gets a note, sends it off with a fishing vessel that's heading back to England, and he pulls out of the race, and he sails straight back down to Tahiti, and he literally puts his boat on the shore, builds a house on the white sandy beach, marries a local girl, has 2 sons, raises them their entire lives living on the beach in Tahiti, never to return to the rat race of England. And it's basically, I'm continuing nonstop towards the Pacific Islands because I'm happy at sea and perhaps to save my soul. So the idea behind these 2 people and the thought that you're supposed to get from this is that, a lot of us, when we're planning for our retirement, we're planning to live like Bernard. And then, a lot of us end up living a life a lot more like Donald Crowhurst. And it gives you that thought. And so again, coming out of the COVID, coming out of everything, the quote that they left us with was basically, if your expectations exceed your income, you're never going to be happy with your financial situation. And so with that, I'll pass it over to Peter to do a little bit of financial planning. Thank you.
Thank you very much, Brad. That was a good story. So my name is Peter Slavkovsky, and I'm the financial planner on our team. And today I would like to talk about financial planning and the financial life cycle. So what is wealth management? For those of you that work with us, you already probably know that it's not only about portfolio management. And we have a big team because each one of us is an expert in different area of wealth management. And as you can see, the portfolio management is still the top priority for us. But we are also looking at the other areas of wealth management, such as risk management, investment planning, tax planning, and estate planning. So today, I would leave portfolio management to experts such as Jeff, and I will talk about the investment planning, tax planning, and estate planning. How many of you want to live till age 98? So there's a chance that 25%, there's 25% chance that either you or your partner is going to live till 98. So if you're planning to retire at your age of 65, you need to enjoy your retirement to the fullest for 33 years. And therefore, it's important to start and plan for your retirement and take advantage of all the tools that are available to us as Canadian investors. This is a financial life cycle of most of the people during their lifetime. And as we are young, we go through the wealth accumulation phase. Some of us realize that earlier in their life, and we start saving when you are young. Some of us realize that later, but I hope that everyone realizes that at some point, because government benefits are not enough. And once you accumulate enough wealth, you will start thinking about retirement. You'll make the decision, you retire, if you have enough, going back to the Brett story. And as we go along, you'll start thinking about legacy and estate planning, because there might be some money left for the future generations. So today, I'm going to share 3 different stories how we were able to help our clients to manage their wealth, to make sure that there is more wealth for their families and for the next generations, and save money for retirement. Wealth accumulation phase. This is the most important phase for your successful retirement. That's for all the young people in the room. And I agree, there are different strategies to save for retirement and to accumulate wealth, such as buying a lottery tickets and winning a lottery, as 2 of our clients in the past 2 years. So there's a little bit of correlation between working with Create Capital Management and winning a lottery. So I'm just throwing it out there. But I would not recommend you to rely on that, because it's important to save and make sure that you have the future in your hands. But to give you a practical example, I'm going to talk about the TFSA. All of you heard the story. You know you should be doing it, but there's still a lot of people who are not using it. So to give you a practical story, we were approached by a young family, 40 years old, with their goal of increase their savings for their retirement. So I sit with them, I prepare the financial plan, and I realized they are doing everything. They are saving money in their RSPs, but they are not utilizing their TFSA account. So we were able to maximize their TFSA accounts. We set them up with the automatic annual contributions every year, so they won't miss the contributions to the retirement funds. And most likely, over the next 20 years, they will have $1.2 million between those 2 TFSA accounts, tax-free, available to them to spend for the retirement. And to break up that number, they only need to contribute $420,000 over those 20 years, and the profits are almost $800,000. So if you divide that number, $800,000, between those 20 years, one of them would have to take a part-time job or a full-time job and make $50,000 a year to match those returns from the TFSA. If you build enough wealth, and if you listen to us during our wealth accumulation phase, you will start thinking about retiring. And the most common question that we are getting from our clients is, people are asking, can I retire? When can I retire? Am I okay to retire? And to answer this question, I will give you another practical story where a 60-year-old couple come to us and ask that question, can I comfortably retire? And again, the process is the same. We go ahead, we want to dig deeper, we want to find out everything about their financial situation, we want to build a detailed financial plan, and that's what we did for them. And during that process, we evaluate every single strategy out there, and we find out that for this particular client, we just want to take 3 simple steps. We manage their RSP withdrawals, we introduce them to the income splitting strategies, and we also explain and make sure that they are using all the tax credits and tax deductions. And as a result, we are able to answer their question, yes, you can comfortably retire. And that is the most valuable piece for those clients. And additionally, we will probably save them over the next 30 years up to $500,000 by using these strategies. And here is a quick example of one of them, how to manage your RRSP withdrawals. So let's say that you are 60 years old and you have $500,000 in your RRSP. Most of the people think that they can only start taking money from their RRSPs at their age of 71. But if you do that, your account will double almost to $1 million. And then at your age of 71, you will have to start taking $50,000 and adding those $50,000 into your taxable income. And you will end up in the higher tax bracket. You will lose portion of your old age security pension. And you will still end up with $400,000 at your age of 95, which will be fully taxable as your income. So on the other hand, we can look at your RSP, we can build your financial plan, and we can decide to start taking money at your age of 60. And at that point, you have the full control of your money in your RSP. You can make sure that you're not falling into the higher tax brackets every single year, that you're not losing your OAS benefit every year, and you still end up with $250,000 at your age of 95 in your RSP account. So this is just one simple example of how we can slowly save you a significant amount of money over your whole retirement. And as you work with us, you listen to us during your wealth accumulation phase, you make the decision to retire, we keep updating your financial plan, we keep making sure that there isn't anything new that came up and you should be taking advantage of. And you might realize that, oh, I might have more money than I actually need. And that's the time when you start thinking about your legacy and estate planning. So to follow through with the previous case, the same 60-year-old couple came to us, and after we reviewed their financial plan, they realized that they have more money than they actually need. They were also business owners, and they asked us a question: how can we pass this wealth to the next generation? Because we will most likely won't need this. And because we knew their financial plan from A to Z, we are able to introduce them to another alternative investment strategy using the estate bond. And that estate bond is essentially corporately owned life insurance policy, which efficiently lowers annual taxes in their corporation, and also the total death benefit is paid out with minimal tax implications to their beneficiaries. And as a result, we were able to help and increase the wealth that will be transferred to their kids by $1.2 million. But what if you're not a corporate owner? Don't worry. This strategy can also work for you if you're retired and if your annual income is over $100,000 a year. Because again, at that time, you have a problem of tax, falling into the higher tax brackets, and losing your old age security pension. So by exploring this strategy, we can save you up to $20,000 a year over your whole retirement period. And as you could see with the previous case, the corporate owners can benefit from this strategy the most. And in this case, we were able to save them $1.2 million for their kids. But the numbers depends on your specific situation. And lastly, how many of you have a family cottage? Would you like to see that family cottage being passed to the next generation? Because if you do, I'm sure you know all the taxes that are associated with the transfer of your cottage to the next generation. So again, with this strategy, we can utilize this and make sure that the property will be transferred smoothly to the next generation without disturbing their financial lifestyle or their cash flow. and you will make sure that the cottage will stay in the family with all the memories, and the kids will be happy enjoying that. So with that said, I would like to pass it over to our virtual portfolio manager for tonight, Jeff Rivett.
Thank you, Peter. Everyone can see me? Awesome, yeah. So my name is Jeff Rivett. I think most people probably know me, but for the guests that are here, I'm the lead portfolio manager for Creek Capital Management, which means that I'm the guy who gets in trouble when things go wrong. I have a lot to talk about tonight with regards to our expectations for the market in the next 3 months to a year. And I'll certainly spend time going through that. I've also got some details on the portfolio as far as how we're positioned right now in our balanced model, all the different things that we own and why. And so I'll go through that as well. But I just wanted to sort of take some time to sort of pause and again, reflecting back on what Brett and Peter were saying, really looking at what wealth is. And I think that, certainly our role is always as investment managers. You hire us to grow your portfolio as much as we can, and our job is to maximize return for the least amount of risk possible. And that's all well and good, but as Brett was going through looking at people's titles, we're more than investment managers. We're wealth advisors, and I'm fortunate. I've been doing this for 15 years. Brett's going on 23. Anissa's also been in this industry for a few decades as well. And with that comes a lot of experience in really working with hundreds of different families and seeing how people treat their money and how people use money as a tool. And it's quite a unique opportunity. I don't think there's anyone else that really gets the opportunity we do to be able to see how these hundreds of families that we've had the pleasure of working with utilize their assets. And the reality is we bury a lot of clients with a lot of money. And so I understand, of course, that there's a sense of comfort, and there's a desire to always want to have more. But I think it's important to sort of pause and take into account this idea of why and what is enough. And I hate to break it to everyone, of course, but we're all going to die someday. And the idea that of just sort of growing money for the sake of growing it. Our team, we manage close to $600 million now, which is great. But, for us, it's wonderful to be able to grow that pile. But of course, the real passion and the real purpose, certainly in my role, is wanting to see that money be used by all of you to really find your purpose, and whether that is gifting to your children, whether it's gifting to charities, or whether it's just having a comfortable retirement so that you can enjoy and do things that are fulfilling for yourself. I think that it's we're very underutilized as far as our ability to help you really decide and define and work with you on these planning to really give you that confidence that you're okay, and you can do these these things, and sort of dig out and talk about what your dreams are and see if they're possible. And it's not just okay, I'm going to retire and I'm gonna just gonna coast by and just sit on my money and watch it grow. Again, seen a lot of people stress about the market, seen a lot of people pay a lot of attention to the market only to pass away and have their children buy a place in Whistler. So just real quickly, I know that you skipped forward on this slide here already on Steve Jobs, but I found this on Reddit last week, and I thought it was great. These are some of the last words that Steve wrote in his journal. Steve died at age 56. Obviously, achieved the maximum amount of success this world has to offer. I'll just give you guys a minute. You've probably already read the quote, but just give a few seconds just to have a read through if you haven't. So for me, really, it's this idea that, wealth is just a life experience I've had the opportunity to know. And I think that for nearly all of our clients, we're all in different ways had this opportunity to have wealth as a tool, and this idea that really wealth is a tool that creates opportunity. The more you have, the more options you have. But again, just want to sort of leave everyone with that thinking that we'll always do our job to grow money the best we can. That's what you hire us for. But you pay us for more than that, and we certainly want to make sure that we're being utilized to help you really plan for your families and really find purpose with what you have too. So we'll skip ahead to the next slide, and I'll talk about the markets. So just an overview of sort of the market performance year to date, and this slide's not showing my highlights, but there's really, it's been a really crummy 21 months. Really, the market peaked at the end of 2021, and it's sort of been a pretty tough last 21 months. Certainly last year, 2022, was negative pretty much across the board. This year we've seen some rebounds. We've seen, sort of bits and starts, and then faded. And certainly even the last few weeks have been tough. But looking at the end of August, there's sort of two things that stand out. And I apologize, I don't think I can control the slides and highlight. But two things that I would show. One is the S&P 500 in the U.S. Has really led the market, and the S&P 500 has, as the end of August, was up almost 19%. This was after being down more than that last year. But really, this is a story of the major tech names. And so, there's 500 companies. The S&P 500 is the 500 largest companies in the U.S., and it's an index that measures the performance of those 500 companies. However, the big 7 tech names, mainly Amazon, Apple, Facebook, NVIDIA, Tesla, and Google, I'm missing one more. There's a 7. Microsoft. Those 7 companies make up 40% of the S&P 500, which means that the other 493 companies make up 60%. And so really, when looking at that index, it's the performance of those companies that has really driven it. And we were really fortunate this year. In hindsight, always, of course, would rather had more technology companies, but we had investments in many of those, and our U.S. portfolio performed and continues to outperform this year. The other thing to point out is the bond performance near the top, and this is over the market total returns chart. Bonds this year are up 1%, and this is coming off last year and 2022 and 2021, where bonds were negative. And I was here last year talking about how the 2022 bond crash was the worst bond crash in history, in recorded history, and we're still. The bleeding has stopped, but bonds have yet to recover. And as I go through tonight and sort of talk about where the market is in the coming in the coming quarter up to the coming next few years, the major theme and how we see the markets right now is that bonds are going to outperform stocks, and this is probably the first time in my career that that's happened. But it's because interest rates are high, bonds are paying a ton, and they're really depressed in price. And the reason they're depressed in price is because rates have gone up so much, and the expectation is that rates will come down in the next few years. And so we not only will get paid the interest for owning bonds, but we'll see a significant growth in the price as well. And so as we're talking about the portfolio and how we're positioned, again, always looking for how do we maximize return with the least amount of risk possible. Bonds are clearly an area right now where we see that being maximized, that sort of risk-adjusted return. You can switch to the next slide, please. So just sort of looking again quickly at the S&P 500. This is a 2-year chart of a few things. The red line is those 7 tech companies I talked about. So again, we saw a massive crash in these companies last year over 2022, falling nearly 40%, and they recovered strongly to start at the beginning of the year. and sort of caught up and led the S&P 500, which is the broader index. And so the story of this is that, you know, this is going back to the end of going back a few weeks ago, so it's not completely up to date for right now. But as we sit, the U.S. stock market is about 6% below where it was at the beginning of 2022. The Canadian market's about 10% below where it began 2022. So equities have been challenged, but you know, we've seen a pretty strong recovery from where we were in December of 2022 and where we started the year. Next slide, please. And this recovery that we've seen is somewhat surprising because it's come at a time when interest rates are very high and continue to go higher. And typically, higher interest rates correlate with poor stock markets, and that's sort of intuitive because the higher interest rate costs are, generally the weaker the economy is because people have less money to spend on dinners and vacations, and businesses have less money to invest and to hire because they're spending so much servicing their debt. So the fact that we've had this big market recovery this year, in spite of rates rising so much, is a bit of a shock. And next slide, please. And so the reason why we've sort of seen this is because GDP, so gross domestic product, or basically we could say the economy is very, very strong. U.S. GDP is forecasted to be nearly 6% for this quarter ending this month, which, looking back over the last sort of 15 years, is an extremely strong spike up. And so this has sort of created this hope, I guess, that we can achieve what's known as a soft landing, which is, you know, we have inflation, we have to raise rates to sort of curb inflation, but how do we raise rates without crushing the economy, and how do we make everything run smoothly? And if you switch to the next slide, looking at the term soft landing, looking at Google searches, it's a very popular thing right now, on par with the Barbie movie, as far as people looking up this idea of what a soft landing is. And so, you know, for our part, we certainly hope that we have a soft landing. We certainly hope that the stock market can continue to climb out of the hole that we're in, and that inflation will come down. But we also want to be realistic, and we want to position our portfolios to make sure that if that doesn't happen, we're doing the best we can for you. So looking at sort of where interest rates are now, this chart shows interest rate expectations going forward, but it also shows what those expectations have been, what they were 18 months ago in green, what they were 12 months ago, 9 months ago, 6 months ago, 3 months ago, and now. And so what's clear from this graph is two things. Number one is that people's expectations of where rates are going to be, and the market's expectation of interest rates has continuously shifted up and had to readjust over the past 18 months, which is why the bond market has been so challenged. But also looking at the current dotted line at the top, the expectation is that rates will probably go a bit higher before they start coming down, and we see them drop over the next 2 years. So again, keeping in mind this idea that yes, interest rates are high, yes, they will probably go higher, but we do expect that they will come down over the next 2 years. The reason that rates are expected to go up still is because inflation, while it's come down a whole bunch, is still persistent. You know, we're looking at this time last year, inflation around 8%, and now we're down to around 3%. So a significant improvement. However, inflation is measured year over year, meaning we're always looking September to last September, October to last October. And because inflation started to decline so much last fall, we're looking back at a lower prices. And because those prices are getting lower and lower as we move forward in history, stagnant, stable prices make inflation look like that's higher than it is. So what that means is that we don't expect inflation to be a persistent problem, but we do expect to see that inflation could creep back up to near 4% to start 2024, which is why we don't expect rates to start falling probably until at least the first quarter of next year. Another sort of challenge to the soft landing is this idea of all the money that was accumulated during COVID. So we had this massive accumulation as people were trapped at home and couldn't go out and spend, where we had this $2 trillion in excess savings. And measuring that going forward, or measuring that what's happened since sort of the end of the major lockdowns in 2020, mid-2021, that all that money has now been spent. So all that stimulus that came into the economy that really pushed GDP up and which really fueled the economy and fueled travel and fueled many industries this past 2 years, that powder is essentially dried up, and that again creates some challenges for the stock market, and again is why we're somewhat concerned about equity prices going forward. Next slide, please. Another challenge is that, or another sort of sign of economic weakness is that delinquency rates are up on mortgages, on credit cards, on auto loans. Student loans are the only area where delinquencies haven't increased, but that's because there was a relief program brought in by the Biden administration to relieve student loans, which will be expiring soon, and so we'd expect to see those come up too. So again, this fact that there's less fuel, there's less excess savings is starting to show up in some of these numbers. Next slide, please. Looking at unemployment or employment, still very, very strong. This time last year, there was 2 jobs available per unemployed person. There's still 1.5 jobs. This is still at record highs as far as employment opportunities go, but it has come down, and we're seeing employment opportunities start to slow a bit as well. Next slide, please. Another sort of major stall out has been expectations from China. So China was slow to come back from the COVID lockdowns, and when we started off 2023, China was opening its doors, and the expectations was we have this big sort of global GDP growth fuel coming from China. And looking at Chinese credit, or the amount of credit being issued in China as a barometer for how strong the Chinese economy is, we can see that it's faltered in the last few months. And typically, what the blue line is showing is how stocks have done versus bonds, depending on the strength of the Chinese economy as measured by credit. And so the fact that we've seen this sort of decline in credit and the Chinese economy suggests again that stocks have probably done a bit better than they should have versus bonds, and we would again expect to see bonds outperform in the coming quarters. Next slide, please. We still expect there'll be a recession. That's another sort of headwind that's ahead of us in probably the coming 6 to 12 months. What the chart on the left shows, these spikes up, is a measure of an inverted yield curve. And an inverted yield curve, simply speaking, is when short-term interest rates are higher than long-term interest rates. So right now, for instance, if you go to the bank and you want to invest in a GIC, or you want to buy a short-term bond, you will get paid more for a 1 year than you will for a 5 year. And that's sort of counterintuitive. It's typically the longer you would lock in your money, the higher rate you would get. But because the market expects rates to fall, the yield curve is inverted, and you actually get lower rates for going out longer. And so typically when the market expects lower rates are coming because there's expected to be economic weakness, there's expected to be the need to lower rates. And so this metric tends to predict recessions. It's the most accurate predictor we've had. And so the red dotted line going across that chart shows that every time the yield curve, that more than 60% of the yield curve has been inverted, going back to the 1960s, The gray bar is a recession. And so every time the yield curve has crossed and inverted more than 60%, a recession has followed. And so this is why recessions have really been the talk for the past year. For our part, we crossed that red line in November 2022, so just about a year ago. And in the top right corner, looking at these past recessions going back to 1969, the column on the far right shows how long after we crossed that line did a recession follow. And typically it was between 7 and 18 months. So again, we crossed that line in November 2022. We're at about 10 months out right now. So, the expectation is that we will see a recession come. Now, that doesn't necessarily mean that we're going to have a repeat of 2008. We certainly would never expect that. That was a banking crisis. And we could have a mild recession. In fact, I've talked a lot in the videos I've sent out in my monthly updates about how typically the stock market actually does better during recessions than it does in the period leading up to a recession. So it isn't a reason for alarm, but again, it's a reason to expect that that investing in equities could be a bit of a challenge. Next slide, please. Again, this is just a chart showing the valuation of stocks versus bonds. That's at a sort of a 25-year high as far as the price of stocks to bonds. Next slide, please. And then this is sort of a chart showing the equity risk premium. And the best way to explain what that is when I met with you guys 2 years ago and we had the option of buying safe investments, bonds, GICs. The interest rate you would get on those was like 2 to 3%, versus the stock market. The long-term return is about 9%. And so, you want 2 or 3 in safe money, or do you want a long-term expected return of 9 in stocks? And so there's about a 6% premium that you were paid for taking the risk of owning stocks. And of course, now with bonds and safer investments offering close to 6% and equity market returns, even if they are 9 and they could be lower than that over the next few years, that premium for owning equities has certainly been reduced. So next slide, please. And then just sort of last on the charts, and I'll hurry up here so I don't take you guys all night. One of the things that we look at all the time, and what National Bank puts out, is this investor sentiment index, which basically looks at optimism or euphoria and fear in the market. And it's a contrarian signal, meaning that when people are the most optimistic about the market tends to be when things go badly, and when people are the most pessimistic about the markets, when usually the time you should be buying. And this was certainly consistent during COVID. It was consistent during the European debt crisis, and vice versa. When times have been really optimistic, we tend to see the markets drag a bit. And so we did hit a period where the market crossed that threshold. We just got through a period of quite a bit of optimism coming off this run in tech names that we had. Thank you. For next slide. So this is how we're positioned right now, and how we see the investment world. Again, for us, it's not about always having to own stocks. It's about how do we get the most return we can for the least amount of risk possible. And this is how we sort of see it today. And that is, owning, being overweight in cash and fixed income, being underweight in equities. We have a bit of alternatives, specifically gold. We're overweight in. And if you flip forward to the next slide, this is a current snapshot of our balance model portfolio and the weightings that we have in the different sectors. And so, a couple things to point out when we look at the equity side at the top: Canadian, US, international, and emerging markets. We're at about 50%, and we could be as low as 30%. That's sort of the minimum that in a balanced account that we can have for equity. 50 is pretty low. We can have as high as 65. I think the last time we had close to 50 was pre-COVID, and that was a good call. It worked out well. We were able to manage through that downtrend and bounce back well. Now, I get the question, well, why do we own any equities? And the reality is because we don't know what could happen, right? I mean, the market shot up after COVID, and no one expected that. Anything could certainly happen. But when it comes to the equities that we own, this is where active management and what we do day to day, and really picking the investments is so important, because we want to make sure that the investments that we own are really maximizing or giving us the most safety possible when we have a market like this that looks vulnerable. We have a 6% weighting in gold. And we also own, in our Canadian equity portfolio, we have a 2% weighting in Wheaton Precious Metals, which is a gold royalty trust. So, you know, we have quite a bit in gold right now, and I'll talk a bit more about that and sort of why that is. And then in the bottom section, these are all of our fixed income holdings. And again, this is where we really think that where the market's going to show, where the biggest returns actually going to be in the next 3 years, and where we see the most opportunity. And I'll just get you to advance the slide and focus on those specifically, please. Oh, so go back one, sorry. So just a quick reminder. So again, I showed this chart earlier with the market expectations for interest rates over the next 2 years. So when we're looking at stocks and stocks are much more a function of optimism and human behavior, and yes, there's a fundamental part to the stock market, but it also is largely tied to optimism and people's hope for the abilities of a company to grow and what they're going to do. Bonds are just math. So, you know, interest rates go up, bonds go down. Interest rates go down, bonds go up. And so when I look at this chart and I see that, you know, in sort of late 2025, so call it 2 years from now, we would expect to see rates 1.5% lower, you can draw a parallel across to when the last time rates were that low, and that would take us to about this time last year, sort of in, well, I guess it'd be summer 2022 when we had rates at around the 4% level. And so we can actually look and see, you know, where were these bond investments then? And it gives us a pretty good predictor of what the upside is on those investments, because as rates come back down to those levels, we would expect the bonds to return back to those prices that they were at when rates were there. So flip forward, please. So this is just, again, a list of the different fixed income. You know, I use the term bonds and fixed income interchangeably, but the different investments that we have right now, sorted by the largest weighting down to the smallest. The column in red is how much each of these categories are down from the end of 2021. And so again, a significant drawdown in all these investments. The yield column is currently what we're getting paid to hold these. So on average, we're getting about 5.6% from these investments, which is a pretty good return. And more importantly, on the right, this is what I was talking about when we forecasted. Okay, well, if rates do come down by 1% over the next 2 years, what will the price of these investments go up by? And so we see, on average, about a 14% increase that we would expect from this asset category. So again, you know, 5.6% you're getting paid every year as a yield. And then this expectation that sometime in the next 2 years, we're going to see an additional 14%. That's how we get to this expectation that our bond portfolio could realistically, bond investors and safe investors could earn 10 to 12% in the next couple of years on this investments. And again, why we see it being so promising. I talked about gold earlier and the fact that we have, you know, 6% in gold. We've always had a bit in gold. We've got a bit more now. And that is because gold is portfolio insurance. As you can see, both during COVID and during 2008, you know, gold really spiked up during those times of crisis. And it tends to be a bit of a low volatility fear trade. So when things are going badly in the world, if there's any sort of crisis, gold tends to do really well. Now, gold has been pretty stagnant. I think that's largely because cryptocurrencies have sort of taken the place of gold as a trade, where people are using those now as an alternative to sort of as an alternative from gold. But really, gold is, again, both portfolio insurance, but it's also an inflation hedge. And so when I look at this chart and I see, you know, gold is basically the same price as it was in mid-2020. And in fact, it's really pretty much the same price or a little bit above, but pretty close to the same price it was in 2011. That tells me, and over that period of time, from 2020 to today, cumulative inflation has been about 18%, yet gold hasn't moved. Going back to 2011, prices, the CPI, inflation over that period of time has increased by almost 40%. Again, gold still relatively flat. So, we see gold as having lagged. We see it having a fair amount of upside to catch up with inflation. And again, it provides us a safety during this time when things are a bit uncertain in the economy. Next slide, thanks. So just getting back to equities, and again, the idea of why we own equities and the equities we own. I'll take sort of the last 5 or 10 minutes just to sort of go through the portfolio real quick and talk about some of the names that we own and why. Just again to create that, so that you can understand how we're aligned and our thinking. I just wanted to sort of go through and talk about the specific investments and again set the landscape of how we're positioned, and despite the fact that we do see bonds as being this great investment, we do still see a lot of opportunities in the stocks that we own. And these stocks are what we typically look for, and what we're looking for now is safety, and that comes from companies that either have products that are recession-proof or sort of that consumer necessity, companies that have strong dividends and cash flow that are paying us a lot to own them, companies that are discounted already a whole bunch, that they've either fallen or they've been sort of underpriced. So we would expect that the future or the ability for them to fall further is somewhat muted. And again, these are all industries that we think that even in a tougher economy, we're going to see them do quite well. And so we've more than ever, these sort of 25 companies that we own across these different sectors really matter what those names are. And so we've organized them, or I've organized them in sort of the biggest to smallest positions, and I'll just go through them quickly. So the biggest area we own right now is really the defensive names, and these are companies that typically do very well during recessions. So in our portfolio right now, we have Estee Lauder, Diageo, L'Oreal, Nestle. So basically cosmetics, booze, and chocolate. And these are the same companies. When we look at their annual reports from 2008, 2009, which was sort of the last major recession. We had a recession during COVID, but it was so short, it's hard to really even account for that. But the last major recession in 2008, 2009, these are companies that their profits actually went up during that period. And that's because even when people don't have a lot of money, they drink, they eat chocolate, and half the population goes out and buys cosmetics. Maybe more than half nowadays, who knows? But these are companies that are extremely stable. They pay pretty good dividends, as you can see by the yield, and they're already, the drawdown column is showing sort of where they are from their peak or their annual high. Estee Lauder's sort of one that we've added recently. Again, that it's had some issues with its business in China, but we see that being a temporary thing and see the future being quite bright for that company. And again, we see the ability for these companies to withstand the economy being quite strong. Second biggest weighting is technology. Again, technology has been a great thing to own this year. We were very overweight. It was definitely our largest sector weighting to start the year, which again, I said paid off very, very well. When you compare how much technology we own to the technology companies and the weighting of a typical mutual fund or a typical sort of off-the-shelf portfolio, we are very underweight technology. Technology should be the largest for everybody, and it pretty much is for almost every manager. It's our second largest, and we've chosen and we have actively been trimming it and adding to bonds and cutting it back as it's been succeeding this year, because of the fact that it is quite volatile and it can be quite sensitive to risk. And so not a lot of yield in the technology sector, but there's already been a fair amount of drawdown that's happened in these companies. So there's already some a bit of a discount. We're not buying them at highs. Companies like Microsoft, I think, is probably my favorite right now because of the investment. They own 49% of ChatGPT, so they're sort of at the forefront of the artificial intelligence trade, which I think is very exciting and could really have big benefits to that company over the coming years. So again, we see these companies being steady. We see the demand for technology continuing to be steady, but again, try to trim down and keep it focused on these core names that we love. The next would be consumer companies. So again, these are, unlike defensive consumer stocks, these ones are a bit more volatile because they rely a bit on the economy, on people spending. Yields are okay, but the companies themselves are of course very stable, household names. And overall, when we look at the drawdowns, especially on companies like Nike and Disney, already a lot of potential negativity priced in. So owning them here, I think, is a big positive. And companies like Visa and Costco and Home Depot, well, they could see a drop in price if there was a correction in the market. It's the kind of company where it's not something we're really going to worry too much about, because we know the businesses themselves are gonna push right through and recover, and we'd see that as an opportunity to buy more. Canadian banks. Next biggest sector, we own Scotiabank, National Bank, Royal Bank. Good dividends right now, especially from Scotia, and they're all down about 14-16%. So again, we see it as a great opportunity. I mean, every time going back to the 80s, the banks have been down. You should have bought them. So we're still actively adding to them. They're a key piece of the portfolio. We like the yield, and we expect that they'll outperform the market in the coming quarters. Utilities and transport. So again, these are companies that have stable cash flow, predictable revenues. Companies like CN Rail, of course, are a bit more tied to the general economy. But overall, good dividend yields from these companies. Fairly predictable, fairly low volatility. So when we have the market volatility pick up, these companies tend to outperform. And as seen by the drawdowns, these are companies that haven't really done much in the last year and a half. They're still quite a bit down from where they were a year and a half ago. Energy is always sort of a difficult area. People have different opinions about it. Energy is and oil, as a trade, we expect to really outperform in the coming year, and that's for a couple of reasons. One, oil is around $90 a barrel. That's really high. The stocks haven't really reflected that yet. So all these companies are going to be cashing in big time on that price, and they haven't really, the stock market hasn't really picked up on that yet. And not only that, but we expect oil prices to spike up even more, because we see things like the U.S. strategic reserves. The U.S. holds a bunch of oil in storage so that they can sort of manage the supply and demand. Of course, with gas prices shooting up last year, the U.S. strategic reserves were almost drained out. They're going to have to refill those, so that's going to create a big demand for oil, and we expect the prices to go up. And at the same time, when you look at the current inventories of oil, we've got about 45 days globally of supply on hand, and that's historically really low. So we expect that despite people's opinions on energy and whether we should, get rid of it all and go to electric, what have you, certainly in the next few months as an investor, it looks really attractive, and it looks like a relatively safe place where, again, we can see outperformance in the market. And these companies are all sort of, very, very low cost, stable properties, not a lot of development, very predictable cash flows. So we see good opportunity there. And next slide, please. Materials. So, I talked about Wheaton Precious Metals, which is a gold royalty trust. We've got a good chunk in that, and then our investment in copper in Capstone. That's a Canadian company with very low risk mines, and when it comes to copper mining, a lot of times there's a lot of jurisdictional risk because of where the mines are located. Capstone has got properties that are all very accessible in very stable locations, and copper in general. It does tend to flow with the economy, but with all the electrification that's been happening, demand for copper is just hitting all-time highs and continuing to grow. And at the same time, building copper mines is extremely expensive. There's a lot of regulatory procedures. They're very slow to get built, and so we do expect, just like in energy, that copper demand will outpace supply, and we'll see copper prices increase. And Capstone is a great company to take advantage of that in the next few years. Lastly, excuse me, with healthcare, we have one investment, which is an ETF, an exchange traded fund that owns basically the largest healthcare companies globally. Now, this is a covered call writing fund, which means that essentially the company actively sells off the upside, to create yield. So it's generating almost 9% in dividends, which is phenomenal. It's not expected to really increase in price a whole bunch because there's been so much that's coming through in the yield. But you can see the drawdown's actually been pretty low. Healthcare is an area we expect with aging demographics, with just the move towards healthcare after the last pandemic. It's an area we see growth. So just in summary, real quick, this idea that we do believe that that the opportunities for us, the opportunities as active managers, really do exist in really positioning our portfolios to maximize return for risk, and see fixed income as a great place to really find those returns. And while we don't know for sure what's going to happen in the equity markets, we do expect there to be these challenges to the economy. And so we've built this portfolio for you that really addresses those, we think, and really positions us well for the year ahead. So I'll leave it at that and take questions.
Brett, Jeff, and Peter. And so now we can have some... And so now we can take some questions, if there are any questions in there.
Hi, Jeff.
Hello, Stephen.
Hi. There's a lot of talk about AI in the market. Are we invest in any of those in particular?
Yeah, I mean, we have, like I said, Microsoft, which owns nearly a majority stake in sort of the largest AI company, being ChatGPT. There is a lot of smaller AI companies out there right now, and those are AI is a trendy trade. I do think that it'll be a business. It could certainly change the world, but it's in that new space like 3D printing or cannabis or crypto, or it's sort of the hot thing right now, and so people want exposure to it. But my experience has always taught me that the big companies that have the power, they're ultimately most likely going to be the ones who are going to benefit the most. So rather than taking the risk and buying smaller companies, they could potentially go up by 2 or 3 times. It's really difficult to predict that, and I don't have enough industry knowledge of who the best AI companies are. So I'm effectively passing that off to Microsoft and saying, what, you guys know what you're doing. We're gonna come alongside you. You're gonna be one of our biggest holdings in the technology space because we believe you know what you're doing in that area.
Hi, Jeff. In your chart, you say drawdown. Is it drawdown from 1 year ago or from what time frame? Your stock charts.
Yeah, it's drawdown from the 52-week high. So that's calculated as basically over the last 12 months, looking at what the maximum price of those companies were, where they're at today versus what the maximum they've been in the last 52 weeks.
Okay, I noted in your forecasts for interest rates that looking 2 years out, there seems to be a sweet spot of between 3 and 4% for all of the predictions that you showed the prediction for. What do you have any sense in what the implication would be if you're wrong? i.e. the interest rates do not settle out at 3 or 4%, they settle out at 6%.
Yeah, so I mean, I guess the that would be a negative for pretty much everything, in the fact that again, bond prices you'd expect would fall because as rates go up, bond prices go down. Now, there's a bit of a logarithmic ness, not to get super mathy, but when rates go from 0 to 1%, that creates bond prices dropping much more than 1 to 2, and much less than 2 to 3, and much less than 3 to 4, and much less than 5 to 6. So the actual pain in the portfolio, now if rates went to 12 or 15 or 18, like that's a different story. But if we're wrong and rates go up to 5 or 6, it would be a negative. But bonds would still produce a positive return, and that's because we're getting paid, 5.5%, 6% now to hold them, and we're getting that no matter what. And so even though we would see prices come down, it would be still a relatively safe investment on a net basis because of the dividends and interest coming in. So that would be okay. I think that the stock market would again be challenged because higher rates would challenge the economy. So under that scenario, what's the best investment to own if rates go to 6 or 7? I would be cash, right? And we do have, and talk about it, but we do have about 5% in cash right now, and that cash is earning about 4.7%. So we're earning a decent return on cash, and as rates go up, the rates on that would go higher. So that's certainly that no one wins when rates are going up, and everyone wins when rates are going down. But for our part, we can't predict the future. We just look at what the best expectation is, and we try to position the portfolio to do the best we can for you guys. So.
Any other questions? Oh, I think actually there's one more over there too, so we'll let them, and then, yeah,
Hey, Jeff, I see that the US dollar is going down. Is that a sort of a trend that we see going forward?
Our expectation, well, our chief economist, Stefan Marion, was out last week, and he sees the Canadian dollar actually weakening again, just as sort of the economy contracts. So the prediction, and again, I'm without getting too much into the modeling for it, we have the Canadian dollar about $1.40, which is around 70 cents US. So I guess it's not a tremendous change, but we're not afraid to own U.S. dollars, and we do have an overweight in the Canadian economy. Our Canadian equities are higher than U.S., and that hasn't always been the case. That's been a relatively new change this year that we've been focused on Canada, and that's just a function of banks and energy and materials and utilities and all these sectors that we want to own. But we would, our expectation in simple terms is that we would see the Canadian dollar around 70 cents, or get to about 70 cents in the next few quarters.
So that means I'll stay at home and shop in Canada then.
For now, yeah.
Yeah, I just have a question regarding your new fee schedule. So the way I'm reading into that is that it's a flat rate no matter how many times I call you or how many transactions we make. I know it's definitely increased my, fee. So I just wanted a little explanation on that.
Yeah, so we have a floating fee schedule, I guess, certainly similar to the graduated rates on taxes. Not that you ever want to be compared to that, but in general, the more money you have, the lower the rate is, and that effectively balances off the need to for servicing clients. So on average, we looked at where our rates were. We looked at several different firms across the industry, where they were at, and we found that we were about 10% below the industry average. And again, for us, it's we've had a lot of feedback, and quite rightfully so. I mean, costs have gone up for everybody. People are trying to fund their retirements. what a great time for us to be taking more so that there's less for you to spend. And I totally understand that. But it's also, it's a easy excuse, but the reality is we've got to find people who can live and work downtown, and the starting wage for admin staff has basically doubled in the past 5 years for that, and our costs have gone up extremely as well. So our hope is to be able to basically continue to deliver on client service, and the reality is the costs will be moving up. Now, nothing changes as far as householding. We look at accounts based on the total amount that a couple has. If a couple has their family, then we consider the whole family as one big unit. So, again, our goal, of course, from a business perspective, the more we charge, the better. But ultimately, if you guys don't make enough money, then we're not going to have any clients. So for us, it's always focusing on how can we get those fees as low as possible and still be able to serve. And so, having that householding, being able to bring on family members, being able to bring on new assets, being able to get the amount per family as high as possible allows us to cut that rate down. Certainly that's always the goal. So, but yeah, there's no, we don't have any transaction costs. Our fees have always been all inclusive for all the costs and all the portfolio management and all the wealth advisory work, right? So from again, we're being underutilized. You're essentially, if you're not using Peter, if you're not sitting down with us and really talking about, okay, like, I have this, I want to give to my kids. I want to retire, but I don't know what I can do with it. I don't feel comfortable spending this much. Like, these are all things where, we're here to help with, and that's all included as well.
So, is it on? Yeah. So one of the companies we talked about is Tesla. So they've been around for a while. We see their stock go up. There's got to be some competition that's chomping at them right now that could be coming into the market, that can take over more of the market share with regards to e-vehicles. That's we can see a lot of growth in that as well. To make the batteries, the lithium batteries, and so forth, the materials. What kind of companies are we looking in those aspects?
So specifically in EVs, I don't have, I find like it's like autos are not a sexy sector, and they never have been, but EVs have sort of made them that way. And what I mean by that is, when you look at the multiples that companies trade for based on what they make, a company like General Motors would, trade at a price to earnings multiple. So, looking at the price compared to what they make of, less than 10 times versus a company like Apple or an exciting company like, like one of the tech companies might be at 20 or 30 times. So when you look at Tesla, it's almost impossible because they don't even really make any money. So my expectation from the EVs is that they're going to become mainstream, and that really at the heart of it, it's just cars. So to try to pick a winner and say, okay, should we buy Volkswagen? Should we buy General Motors? Should we buy some of the smaller like Rivians or some of these key players? I think that there is some maybe opportunity in companies like a Ford in developing the electric trucks. I think that's an interesting area, and we're always looking at that. And if the price came down enough, we would probably take action on it. But again, looking at it from a risk-adjusted return perspective, heading into an uncertain market where companies that have that kind of lofty hot air underneath them because of the sexiness, those are the ones that are going to really get hurt the most. And I always say, our goal, our first goal is always, don't lose money, because if you lose 50%, you have to make 100% to get back to even. And so, when we're looking at a portfolio and looking at what to own and what names to own and what equities to own, certainly we want to see growth. There's no fun in owning equities that are growing, but I feel like right now, I'd rather own the materials like Capstone that's actually supplying the copper in general because of the fact that EVs are going to increase, than sort of pick a specific winner. I think again that's while you sometimes can be successful, that's also can be the kind of companies where they go down and they don't come back up again. And we try to avoid those ones as much as we can.
This question is for Peter, and if you find it take too long to answer, you can email to me. I'm interested in the estate bond. How does it save you tax, and also what's the setup fee, and what are the amount? Is it worthwhile for you to set up the bonds like that? Thank you.
Thank you very much for the question. Very good question. But this is for another discussion, I would say, because it's very, very detailed, and it depends on every single one of you and what financial situation you are at. So I'll give you my business card, and we'll chat later. Thank you.
Okay, great. Thank you, everyone. Thank you so much for joining us today. And as always, remember, we're here for you, and feel free to reach out to any one of us. Great. Thank you.